Oil prices continue to sit around $60-something a barrel. Shale is continuing to flounder, and the banks are knocking the Shale doors and asking for them to pay back their money, quite simply. Now, where did this Shale glut, where did it start? Okay, and where do we foresee oil prices over the next 12 months in 2020? And I'm going to explain a few things here. First, I want to listen to what Al Kafia here says, and I love what he has to say. You could learn a lot from him, and I'll explain further.
I think it all started, the challenge of our industry started back a decade ago when the financial crisis hit in 2008. You had quantitative easing in the US, and that made cheap credit available. And a lot of that cheap credit went to fuel the shale revolution. So in just a few years, we had 4 million barrels come out of nowhere.
So he said the cheap credit fueled the shale revolution, and 4 million barrels of oil came out of nowhere. Now, he's most certainly correct, okay? And so fundamentally, sorry, I've got sinus and I'm fighting a bug, and so it's hard for me to say certain words. But bottom line, if you look here, this makes sense from 2010 until we get into 2017, but then it stops making sense. Okay, so oil prices go up, and of course, and so the orange here is crude oil prices, okay? And the purple graph is U.S. oil rig count, and the blue is U.S. oil output, okay? This makes a lot of sense. Oil prices go up, U.S. oil rig goes up, the count goes up, and then, of course, U.S. oil output goes up. Now, in 2014, we go from $82 a barrel, 1,600 rigs, and 8.4 million output to 9.17 million output. Oil price is $52 a barrel and only 640 rigs. Okay, well, here's what this is where it gets interesting. Right now, we're at 659 rigs. This shows $63 a barrel, even though we're at $60 because the last recorded date was January 3rd. Okay, but if you look here, oil prices go from $106 a barrel down to $26 a barrel and continue to flounder around 50-something to $60 a barrel. But you look here, shale just continues to grow in a massive way. This makes absolutely no sense. It is not fundamental. It doesn't make any sense. And it's quite simply because of the free money. And so if you look here, the easy to get to credit. Okay, so if you look at 2008, I'm sorry, this doesn't go far enough back here. Let's look at 2008. Okay, so you look, we were producing 3 million barrels a day. You look at the explosive growth, and that was quite simply because of the easy to get to money, okay? And so it's impossible to maintain this chart. To maintain, you cannot continue to keep increasing the oil output and oil prices continue to drop. It doesn't make any sense. It's because it was funded by credit, not funded by investors. It wasn't funded by profits. It was funded by debt. Okay, let's continue.
So it was an induced stimulus. It was not a free market action that gave you the oil glut. So you either wait a very long time for that to correct itself, or you take necessary action. All eyes are on US production again. If there is going to be an extra million barrels, yes, this will suppress oil prices. But the current indicators of rig counts, frac spreads, are telling you that maybe that is going to be a challenge. So my recommendation.
That was an understatement. Okay. And he's being very nice about it. And he mentioned 14 million barrels a day. And right now, let's look at this at a 10 years. These are easier to follow. Right now, we're at 12.4 million a day. And so he's saying 14 million a day because there's been talks about the potential of us getting up to that number and that's quite simply because you got three of the biggest companies in the world, Chevron, Exxon, and Conoco. Quite simply, they're in Shale. And of course, they're going to get on there and boast about output. Because why? Because their investors need that output in order to make money. Okay. But the banks are going to come knocking. All that easy to get to money at some point has to be paid back. Well, they can't pay it back. And under this model, it's just not going to work. Okay. And so there's been a lot of discussion about whether Shale can maintain their current output. And there's been a lot of talk about increasing the output. And so I love Robert Rapier here. He is, every year I love to look forward to his article. He studies every article you can imagine, okay? And he has an energy prediction for 2020. And if you look here, I highlighted a few things here I want to talk about. In contrast, JP Morgan is projecting an oil market deficit this year of 200,000 barrels per day because of OPEC production cuts and demand growth in emerging markets. Okay, so the JP Morgan is expecting a deficit of oil, not a surplus. And they expect oil demand to grow by 1 million barrels per day globally. Okay, that's not what some of the other guys are saying. Okay, and so you got a lot of these clickbait, CNN and these other news agencies that have no idea what they're talking about, and they said oil demand is dropping. Is oil prices going to drop down to nothing? Look, bottom line, if you look at the actual data itself, and you will see that it's consistent with most other forecasts. So to increase 1 million barrels a day of demand is very big for the oil industry, okay? And so there are lots of expectations that we are on the cusp of peak oil demand. But in reality, I think we are still several years from that. Nevertheless, those expectations are creating headwinds for oil prices. But the only way the market corrects those expectations is for crude inventories to decline, okay? Given the strong growth in U.S. shale oil in recent years, that just hasn't happened. And so it just doesn't make sense that shale has continued to grow, and it's because it's artificially stimulated. The money is coming from banks, hedge funds, and creditors, but they're not able to pay them back. And over the next 4 years, they're going to have to pay it all back. This year is the first year that the banks are going to ask for a major portion of what they borrowed. And that's why you're seeing all these shell companies go out of business. And of course, when they ask for their money, the banks are going to have to close doors on a lot of these companies. So it's only going to get worse. Ultimately, I believe OPEC will continue to cut production in order to prop up oil prices. I think U.S. shale production growth is going to continue to slow, and that global oil demand will once again growth to a new record high. So he based on all of the diagrams and the EIA reports he's read and all the research, he's saying oil demand will once again grow to a new record high. Okay. According to the EIA, Energy Information Administration, U.S. oil production closed 2019 at 12.9 million barrels per day. For all of 2019, production averaged 12.2 million per day. To put that in perspective, that's higher production rate for crude oil than any other country has ever had. So we're the top dog for oil production. We outproduce Russia, Saudi Arabia, every country in the world on an individual basis. But, okay, production growth in 2019, 1.2 million barrels per day year over year, was significantly less than 2018's record 1.6 million per day gain. And there's a lot more pressure on oil companies to deliver cash flow to investors. That is going to increase the incentive to focus on producing instead of drilling new wells. Thus, I think shale production growth will fall below 1 million per day this year versus last year. That's also supportive of previous predictions, okay? So to increase 1 million per day demand growth for oil and to lower 1 million a day for shale, that could be huge for oil prices, bottom line. And so that fundamentals come into play when you get rid of that free market, that free money. Okay, all the lenders are drying up. And if you look at, quite simply, if you follow, here's Chevron over the last 10 years. Here's ExxonMobil Corp. And here's ConocoPhillips, 3 of the largest oil companies in the world. You look over the last 10 years, they had major growth. And, excuse me, in 2014, they plateaued. Okay. Then there's a major decline. And then there was an incline. Over the last 4 years, it took 4 years for the market to correct itself. Okay. And so it took 4 years to get from, let's just look at Chevron, from $134 a share, and 4 years later to get to $132 a share. That means everybody that invested in 2014 has seen a decrease, and they're still waiting for it to come back. Oh, well then, look here, it drops down to 111. And so if you look here, everybody investing in oil in the stock markets, they're losing. Okay. Now, if the smart ones that invested at the lows, I mean, there's some lucky ones here that invested at 108 and hit 126. Sure, they're making money, but nobody has faith in that. And so, bottom line, investors, private investors, investors that are investing in the stock market, they're losing in a whole. People that are investing in Shale are losing. Bottom line, the banks are coming back to collect on their investments and expecting their money back. And so you're seeing a massive decline. You're seeing a massive decline in shale growth, quite simply because there's the money is drying up, but the demand is growing. Oil output is dropping, and the Middle East tensions are growing. So you're going to see oil prices in 2020. We by the end of the year, we could very easily be $70 to $90 a barrel, and I think we might touch as high as $100 something a barrel first quarter of 2021. Anyways, there's a lot more to this story. Please follow me. Please subscribe if you like these videos. I'll have more. And if you have any questions or concern, feel free to call me anytime at 307-622-1645. And oil prices right now, last I checked, they're around, well, let's look here. Right now they're at 58. Let's refresh this and make sure it's current. 58.08 today. Brent crude is 64.24. Now, bottom line, people say that $58 oil is low. Well, my business in the conventional realm, $58 a barrel is huge. The first time we hit 50 something dollars a barrel was back end of 2004, early 2005. We thought we hit the lottery. But that's when you're only drilling conventional. You're drilling wells for 600 grand. 50 barrels a day is a lot of money at $50 oil. But if you're drilling a well for $10 to $20 million because shale is very expensive to frack and extract, and then you need $100 oil in order to make a decent profit. Okay, so I'm developing in areas at $50 oil, $40 oil. There's a lot of money to be made. Anyways, I'd love to chat with you. We're drilling the wells at industry cost. We've got a 2-well package for $1.3 million, offsetting a well that produced 50 barrels a day. Love to chat with you about it. If you have any questions, call me. And if you wish to request information, you can look in the description below. Please subscribe to this channel, like I said before, and we'll talk to you soon. Thanks.